In this session, we're going to introduce you now to probably one of the most popular of the pension plans that most of you have probably even heard of, and that is the Registered Retirement Savings Plan, RRSP. These plans, of course, have been around since the late 50s and everything. So it basically is a mechanism that the federal government has given the population an opportunity, a mechanism, whatever it is, to be able to basically save for their own retirement. So on top of the kind of the pension plan, on top of the old age security plans that you get from the government themselves, okay, the government said, okay, you need more than that. And we're going to give you the means to do that. And so therefore they created what is called registered retirement savings plans. Essentially, there are three different types of pension plans, retirement savings plans. The first one is what they call a managed fund. This is where the bulk of the money goes in, and managed fund. And this is where basically all you're really doing is you're cutting, let's say, a check to a bank or insurance company, whatever it is, say for $10,000, and you buy a GIC, segregated funds or mutual funds, and that's it. In other words, they're all managed for you, so this is not something that you have to sort of watch every day and see how it's doing in the market, this, that, and the other. There is somebody else that actually watches all this stuff for you. So it's all managed by the institution that you're actually making the deposit. So be it a bank, an insurance company, trust company, whatever, they actually manage this whole process. So from you as a consumer, you simply have sort of total peace of mind in that respect. The money is safe, money is being invested for you, and that's the end of that. Okay. Self-directed, on the other hand, is quite the opposite. In a self-directed plan, you make the decisions. So here, basically, what happens, you open up a self-directed RSP account, and you decide, okay, where your money's going to be invested. So you want to invest in stocks, you want to invest in bonds, what kind of stocks, what kind of bonds, you've got GICs. In other words, here, you're really sort of your own portfolio manager, you might say. So unless you really know what you're doing, and you have the time to do it, watch the market every day, because now, obviously, here you see somebody else is watching. Now, under self-directed, you're the one that has to watch, basically. So unless you're prepared to spend the time or have the knowledge to be able to do it, we strongly don't recommend you get a self-directed RSP. Okay. The last one is what we call a fully managed one. And this is really where money managers, these are huge institutional money managers that manage billions of dollars, basically. They are portfolio managers. So along with your money, they're managing, billions of dollars of other people's money as well. So they are really the cream of the cream, so to speak, the top of the top. And normally they deal with essentially with high net worth type of clients, whereas this one here, you can start one off at $50 a month if you want. This one here, you really have to have a fair bit of money that's under management and everything. So, but basically what we're saying is these are the three mechanisms, the three different kinds of RSPs that are in the marketplace. The managed one, the number one here, that is the most common one, the vast majority of people, that's where they go, okay. Now there are two tax advantages. The big thing about RSPs is that there are two tax advantages involved here, okay. First of all, the contributions themselves are deductible, okay. So you are able to deduct the premium that you're actually paying. So, for example, let's say that you're in a 40% tax bracket. So that means that every time you make $1, 40 cents of that is gone. What if we were able somehow to reduce that down to 35%? So now for every $1, you're only paying 35 cents in taxes. Well, that's what an RSP deduction does, you see, because by you making that deduction, basically making that contribution to RSP, and now you're deducting that contribution against income. So your income bracket now may drop, let's say, down to 35%. So now, basically, you're saving yourself 5 cents on every $1. So, for example, if you gave me $10,000 and you're now in a 30% tax bracket, I'm going to give you a refund of $3,000. 30% of $10,000, basically. So that's how it works. Basically, is whatever bracket that you happen to be lowered down to, basically that is going to be refunded back to you. So yes, you gave me $10,000, but you're in a 30% tax bracket. 30% of $10,000. I'm going to cut a check back to you. I, being the government, will cut a check back to you when you do your filing at the end of April. Let's say you do your filing and you show the $10,000 RSP contribution. I'm going to refund you back $3,000 of that. So it is a huge, huge savings for the average consumer and everything. Okay. Also, the income that's in there, that $10,000 that's sitting in there, okay, is that income earned in that $10,000 that you gave me is tax sheltered. So therefore, if you are making money, you're not going to get a T3 or T5, let's say, from the institution. It is tax sheltered money. So not only do you get a deduction, so therefore you get a refund at the end of the day, basically, but also the money that is sitting in there and the growth, hopefully, that the growth that you're experiencing in there, all of that will be also tax sheltered. So the end result is you don't have to pay tax on all the earnings. So if you're $5,000 that you had, let's say, open money, you're earning 10%, that's $500, you have to pay tax on that $500. But if that same amount of money was actually registered money, so the same $5,000 into a registered fund, and you also earned 10%, you made that $500, but that $500 will be tax sheltered, and therefore you're not going to get a T5 on that. So you don't have to pay tax on that $500. So you can see there's a huge, huge benefit here. The deductibility as well as tax sheltering are two big, big issues as to why people would buy an RRSP. In terms of contributions, of course, you can make contributions any time you want. However, if you wanted to count, you wanted to credit it for the previous year, in other words, last year, it has to be done no later than 60 days from the end of the year, December 31st. So, for example, this year we are in the year 2017. If you wanted your contributions to count for your income bracket for 2016, then 60 days from December 31st, 2016, to 60 days to basically, in this case here, March the 1st of 2017, you have to make the contribution during that period of time to count for the previous year. If you make it after, it will not count for the previous year. It will count for the current year, but it will not count for the previous year. So if you're going to have, if you want those limits, if you want those that money count for the previous year, you must make that contribution within no later than 60 days from the end of that calendar year. The obvious question is, well, how much can I actually do? Well, the limit is 18% of earned income from the previous year. I'm going to do a calculation in a moment and you'll see what I'm talking about. When I say the previous year, so using 2016, 2017, let's say, as the 2 years in question, it is the earned income not from my 2016, it is my income from 2015. Okay, so you're always 1 year behind. So that's why they're saying it's 18% of earned income from the previous year, not the current year, 2016. So it will be from 2015, basically. So whatever your earnings were in 2015, you then have a credit for your RSP for the taxation year 2016, which again you have to do within that 60 days into 2017, let's say. So I hope it doesn't get too confusing here, but basically all we're saying is that you are 1 year behind on your 18% all the time. You're always 1 year behind because you're always dealing with the previous year's income. So on the exam, you may get a question on the exam that shows the current year's income and you get the previous year's income. It's the previous year's income that you use, not the current year. So if you ever get a table basically with two historical income amounts and everything else, always use the year before. Never use the current year. Okay. There's also a maximum limit. In other words, it's just not 18% of your earnings. Okay. It is 18% of your earnings from the previous year to a maximum of. And every year that maximum could change. So for example, 2016 is roughly about $24,000. And so therefore, even if you had $500,000 of income, you couldn't put in 18% of 500,000 because 18% of 500,000 is much, much more than 24,000. So there is a limit. So it's whichever is the least. So it's 18% of your earned income, no more than the limit. And like I said, in 2016, the limit was around 24,000. So you couldn't put in 30. You had to put in no more than 24. But if your 18% only shows up as $10,000, then that's all you can put in is $10,000, and that's it. So even though the limit may be 24, but your 18% only generated the $10,000 worth of RSP deduction, then that's all you can do. Okay, so it's 18% of earned income from the previous year, whichever is the least from that maximum limit. Okay. the amount of money, that maximum limit, will be reduced. Will be reduced by pension adjustment and past service pension adjustment. You'll recall in previous sessions that I kept on talking about this pension adjustment and past service pension adjustment. I indicated to you that in the defined benefit contribution plan or a deferred profit sharing plan or a pooled registered retirement plan, all of these here have past service pension adjustments. So if you have put money into a defined contribution plan, a defined benefit pension plan, whatever it is, that amount of money will reduce that 18% because that limit, you see, is still, let's say for 2016, it's still $24,000. So you can't put any more. So the fact that you put your money into one plan and now you want to make a further contribution into your RSP, you still have that limit of no more than $24,000, let's say, in the example. So pension adjustment reduces the amount of your limit, and past service pension adjustment also reduce the amount of your limit. The other thing that reduces the limit is your alimony payment. So if you are making alimony payment, okay, to your spouse, whatever, okay, and let's say for argument's sake that your earned income, just for simplicity's sake, was $100,000 at that time. However, you're paying out $50,000 of that to your spouse as alimony payments and everything. Then it's not 18% of $100,000, which would be $18,000. It will be 18% of $50,000 because alimony has to be taken out from your earned income, and then the 18% would apply. So three things that will impact the amount of RSP contribution will be from the limits, okay, is your pension adjustment, PA, your past service pension adjustment, okay, and any alimony that you may be paying to your spouse. And so that reduces the 18% limit as well, okay. There is what they call a lifetime contribution, okay. And a lifetime contribution, basically, an over contribution of $2,000. So if by chance you put in more money than you should have, the government of Canada will allow you a maximum of $2,000 over contribution, lifetime, not yearly, one time only, okay, lifetime contribution, and therefore they will allow that, no penalty. If you put any more money than that, so you put in extra $2,000, extra $5,000, whatever, in other words, you made an over contribution, you will be penalized at the rate of 1% per year. Per month, per year, basically. So the penalties are quite stiff. So you must absolutely make sure that you stay within that limit. Okay, so your limit is 18% of your earned income from the previous year to a maximum of that, minus your pension adjustment, past service adjustments, alimony payments, whatever those have to be, okay, and your $2,000 and everything. If that amount of money is over that limit, whatever that limit is, so your limit, let's say, was $24,000, but you gave me $30,000, on that $6,000 difference, I'm going to charge you 1% per month. So that's 12% a year. So it can be a substantial cost to you. So it is important that you try to stay within, obviously stay within that limit. Okay. Now, very shortly, I'm going to show you also an actual calculation of the RSP. So we'll do that in a moment.